We want to start by thanking you for being here with me. I appreciate you taking the time to join me in this afternoon, evening, if you're on the East Coast, to hear me talk about the infinite banking concept. As an introduction, I want to let you know this is another way that I'm trying to communicate, put out there the message of this process, and it's become part of my purpose. It's something that I think it's worth of my time and my mind. I think about it when I wake up. I think about it before I go to bed. So what I'm going to share with you is going to be a very basic level introductory way of taking a look at what it is, what it represents, and I'm going to share a little bit of my experience with you. All I ask is that regardless of what you do, regardless of your perspective on financial matters in your life, you recognize that money is a very emotional subject, particularly in our society, is very taboo. And I'm just going to ask you to please suspend all your beliefs. I don't hold the truth, the right or wrong. It's just my perspective. And I want you to suspend in your beliefs, take a look at what I'm going to share with you and inspect if what you're doing today could be enhanced or could be improved by using a method that I think is probably at the root cause of a lot of distress in the nation from an economic perspective, but also I think at the same time holds the solution for a lot of families and business owners to take control of their financial matters. So that is the spirit in which I'm doing this. My objective, very simple. I just want to cause you to think. I'm not trying to sell you anything. I'm not trying to convince you of anything. As a matter of fact, it is not important if you agree with me or not. This is my perspective. This is my experience. It's serving my family very well. I just feel compelled to communicate it and engage in productive conversations with folks. Whether you disagree or not with me, I want to cause you to think. And I say this because I want you to also consider that any other financial product advisor, any other entity you engage with is in the business of taking you away from your thinking, numbing you, so you go and comply with whatever direction they want you to follow. In the contrary, my team and I, and most of the folks that are involved in this infinite banking concept, want you to actually take control, take ownership, educate yourself, and work through how can you improve your position every day so you find more prosperity and more unity in your family. So with that being said, again, for those that I think all of you obviously are either clients or friends or family, but my name is David Zapata. I'm part of the Factum Financial team, and we are focused on delivering solutions for folks where they are and creating a bridge where they want to go financially through the use of the infinite banking concept. We believe in bringing families closer together through solutions in finance and having them enjoy a more fulfilling and full of prosperity in their lives today. So with that being said, I want you to remember three things. That's it. If you listen to me for the next 40 minutes and you don't hear most of it, all I want you to know is this next three ideas is the most important part of all this. And I want you to stay with it and consider over the next couple of weeks. And if you feel compelled to have a conversation about it or discuss further, please feel free to reach me. I'll obviously share with you my contact information. You always can reach out to me. But if you do anything today, I want you to remember these three things. And I'm going to go into more explanation of what I mean by this. But today, I want to share three ideas. Number one is that everything you buy, you finance. Whether you recognize it or not, you finance everything you buy. Number two is that in your life, your need for financing is much greater than your need for protection. Again, your need for financing might be the greatest need in your life. And number three, it is my hypothesis, is my proposal to you that infinite banking can enhance anything you're doing currently in your life. It doesn't matter what you're doing. If you're a sophisticated investor and you love the stock market and you have the ability to use leverage with options and you know how to trade derivatives, great, this can enhance it. If you're an employee and you contribute to your 401k every paycheck every Friday, and that's how you're saving for retirement, great. Congratulations for the discipline. This can enhance what you're doing. If you're a real estate investor and you put your money in the real estate market because you control your assets and you have more leverage, great. This can enhance the position of that real estate investing. At the end, what I'm going to propose to you is that you consider that at the bottom of a pyramid that you're building, where risk is the vertical axis of that pyramid, the base, the foundation needs to be really strong. And we need to go after a process, a platform that is the safest and the best place to warehouse our money as we go up the ladder and take more risk in anything that, again, you're doing today through your investing or even speculations. So please keep in mind that this is the context in which I want to communicate to you. And these are the three main ideas that I would like to share with you today. So to set up where we're going to start, I want to give you, I got this statistics from one of the analysts that I purchased research from. And there are different publications, Forbes and a couple others. Oh, excuse me. I'm going to mute you, Ronald, sorry. And they were shocking to me, but they are representative of what I think it's happening in average America. So I'm going to read just a few of them to give you an idea. This may not represent anyone in this group. I'm sure that a lot of you guys are killing it and you feel confident with your processes, and some of you are actually clients and are doing already infinite banking in your businesses and in your personal life or your families. But from an average individual that walks around this country, 53% of adults say that thinking about their financial situation it gives them anxiety. 44% in a different survey from Forbes said that it's stressful to think about their finances. Another one of the statistics was that 66% of American families don't have more than 6 weeks of savings for expenses. Think about that. Think about the year we just had with coronavirus. We went into a financial crisis with almost 18 million people unemployed, a significant amount of small businesses having liquidity issues and closing, businesses not having more than 27 days of free liquid cash to pay for expenses. We're talking about the richest economy in the world. And we're dealing with 2/3 of the country not having more than 6 weeks of paycheck, 6 weeks of money for expenses. So if you lose your job for a month and there would not be any STEMI checks or unemployment checks, these people could only pay 6 weeks of those expenses and they would be on the street. That's incredible to me. And again, you may not feel that that's true because your reality is completely different. But there's people around you walking in the same situation. And the fact that it's a conversation that's full of anxiety and stress makes it difficult for them to open up and for us to have a national conversation about how difficult it is for the average American to live and thrive in America from a financial perspective. This was amazing to me. And thankfully I'm moving far away from this, but I was one of these adults. 78% of adults in America living paycheck to paycheck. Thankfully, through my financial education and the effort that I put every day on advancing that, I left this boat, but this is a significant amount of people in the country. Student loan debt, more than $1.5 trillion. It's incredible. Like, the idea is that the pressures in this country are significant from a financial perspective. And I think personally, this is my opinion, that all the stress we see in society today and all the disruption we see in America is very correlated with wealth gap, with a lot of the distortion between the difference in the lifestyle of the ultra rich and what the average and the poor are experiencing today, because they are seeing through social media and they're seeing through all these different outlets how those people are enjoying a lifestyle of luxury, and they're constantly bombarded by that. But at home, their reality is very different. So for some of you, again, this may be intuitive if you've been following the news and you've seen what's happening in the economy and in the country. One contrasting piece of information that I thought it was fascinating is that most people that got surveyed also were asked what they thought about those wealthy people, where they had gotten their money. And the statistics were very counterintuitive. So what is less understood is that approximately 80% of millionaires in the United States inherited $0. And most people believe that millionaires in America just get their money from trust funds or wealth funds or whoever is giving them that money. But we live in a country of entrepreneurs, and 80% of them inherited nothing. They are self-made millionaires. Another cool statistic that I found is that 33% of these millionaires never made $100,000 in a year. That's amazing to me. You would think that somebody that's in that group is made millions of dollars every year and accumulated that wealth. But this points to me that this is not just about capital accumulation because you have a high income or because you just get a windfall from someone like your parents or your grandparents or something else. This points to me that the millionaires and the billionaires of this country understand how money works in a way that the middle class and poor that are suffering today do not understand. And I think that's at the core of what we're going to talk about today. So today, in the description of the event, I talk a lot about the banking process and why banks in particular are of interest to us in the infinite banking concept. Keep in mind that I'm using banking as a verb, as an action. Banks are institutions and entities, but when I use banking moving forward, I'll probably be referring to an action or a process. But with respect to the banks as institutions, it's really important to recognize that banks are probably the most successful players in the money game in our society. They understand how money flows, they understand how to capture it, they understand how to make a lot of money. So I kept things very basic in this presentation since it's an introduction, but I want to give you insight into what a yearly 10K or what a yearly report on one of these banks would look like with respect to how much money goes out, how much money goes in, and how they are able to play that game so successfully. So in this example, we had some data from Bank of America in one of the recent years. And the bank takes, as all banks do, when we're dealing with depository banking, $909 billion in deposits from you and I and other corporations, of course. They take that money and in some of their savings products, in some of their checking account products, they pay interest for the pleasure of hosting our deposits. And out of the $909 billion, they paid $3.1 billion in interest to us, back to us. Some people applaud that. They think it's great. It's a great way to store your money. It's convenient. You have online access. They're everywhere in every city. Fantastic. The part that is less known and less understood is that Bank of America also took these deposits before giving us that interest and used it. And they used it in the form that is a profitable way to create more money. Not only they charge us fees, but they go and take this money and go lend it out and create velocity with it. They create multiple jobs for the same amount of money to increase their profitability. And through that process, they collected almost $50 billion in interest compared to the $3 billion they paid to us. Keep in mind, these deposits are not the bank's money. That was our money. So they created 50 billion out of no money they had on them. This represents 0.34% compared to 5.5% return on those deposits. And you would say, well, the difference is somewhere around 4%. So what's a big deal? But the misunderstanding is that this is not a subtraction of interest with respect to the deposits. This is how much larger their returns are compared to what they're paying on our deposits, regardless if it's their money or not. 5.5% is 16 times larger than 0.34, meaning they have a return on their deposits of 1,600%. Try to find something that you're doing in your financial today that gives you that type of return. And if you do, please call me because we need to leverage that. But it's incredible how these banks do not use their own money, use our money, our deposits, to efficiently go and create more money and continue to do this year over year only by offering us things like convenience. It's very, very incredible. Just to go a step further, again, very simple diagram. This may seem like it's a little too basic for you. Forgive me if it is, but I wanted to go to the core of the ideas. And if you want any further explanations with more complexity, we can always go there. So we're talking about a bank. So what is a bank doing? Again, taking deposits, you put $10,000 or whatever it is, the amount that you deposit on it, for example, and they are going to pay you an interest rate. We're going to assume in this case that they're paying you an incredible 4%, which is almost impossible to find any institution as a bank that will give you that much interest in your deposits. The bank will take that money and start lending it. They will start issuing a contract for a loan on a house, Somebody wants to buy real estate and they'll charge them 5%. I know, please keep in mind that I understand that current rates are a little lower and that the complexities of today make this a little different. But keep following me as a diagram for you to get the main idea. They're going to take this loan and they're going to start receiving payments for that loan. And they're going to take that same money they received and issue a second loan. They're going to lend now to the person that wants a car, but they're going to charge now 6% on that loan. And as the person that buys the car pays that interest, they're going to take that money and lend it out to the person that wants to do a house remodeling. One of the most popular loans in 2020, people couldn't leave because of coronavirus. So what did they do? Excess money, excess cash, deposit it. And sometimes they leverage and borrow to go and upgrade their home. Now they're going to charge 7%. Now you probably are following my trend here. They're going to take that money, lend it out to debt consolidation, credit cards, whatever instrument they are selling you, and charge you 18% plus. The math here works similarly to what I was showing you before. We're going to start creating a calculation for the arbitrage, the difference between what they're paying in our deposits and what they're getting in this interest. So 4 minus 5 is 5 minus 4 is 1, 6 minus 4 is 2, and blah, blah, blah. So the differential is what we've calculated here. And the total of this differential and interest ends up being 20%. Again, if you go back to what I was saying earlier, it's not just the differential, but how much larger in proportion is the interest they are earning to the interest they're paying. 20 is 5 times larger than 4, which means that it's not 16% that they're earning, it's 500%. And I'm talking about a strict lending of deposits. I haven't even gone into the complexities of fractional lending and the reserves they have at the Federal Reserve Bank and how much more complex it gets, the leverage that we have in our system today. This would be just taking extra deposits and doing a one-to-one lending process at a 500% return. This is the banking process. And all I'm suggesting today is that you consider that perhaps there's a way, just like the institutions do, for you to execute this process in your own life, in your own finances, by yourself, so it benefits you. And the takeaway here is that there's a vehicle in very few places in the world, happen to be in Canada and the United States, where a life insurance policy is a place where you can execute this process for the banking of your life. More on that in a second. Again, if you hear this word and it gives you pause, suspend your disbelief, suspend your skepticism, hear me out, and contrast to what you're doing today in your life. So we've established banks are phenomenal at managing money and creating profits, but where do they keep their savings? Because they're keeping our deposits, but what happens to the money they generate for themselves? Banks are incredibly smart about money, like we said. So the question is, where do they stash them? They do buying whole life insurance policies. Very counterintuitive. Wells Fargo, Bank of America, Chase, Citibank, and a lot of other banks, plus 3,800 other banks. It represents almost 60% of all banks in the United States buy a product called bank-owned life insurance, because that's the most efficient place where they can store securely their profits. We're talking about almost $150 billion in deposits in life insurance policy cash values for this base.
Let's go up.
Oops, sorry, I'm gonna mute Joey and Emmy. And by the way, as I take this pause here for a second, if you want to ask a question or make a comment, if you want to say I'm crazy what I'm saying, please unmute yourself, engage with me. We all learn better when we all are engaging in that conversation, and I always welcome it and invite your feedback. So feel free, and at the end we'll have some space for some questions as well. But the message here is that the largest purchaser of whole life insurance policy is not the middle class, is not the poor, is not even the ultra rich. Is the largest institutions in this world, in this country, banks and corporations. They have over $150 billion in life insurance cash values to store their profits. Why? These are quotes that are extracted from Pirates of Manhattan, and they're quotes that have been known to come from institutions alluding to why they think this is the best place to store their money. Professional money management, tax deferral on growth, unmatched stability, high non-correlated returns. For somebody that's in the business of taking risk with derivatives and loans and all that, having non-correlated correlated returns to that is really, really important because it gives stability to their portfolios, improves their cash flow position, unsurpassed liquidity during a financial crisis. A little bit of history. Life insurance policies provided liquidity to the middle class during the Great Depression. It's shown in movies. Many books talk about this. And during the great financial crisis we had in 2008, life insurance cash values were the only places where liquidity was guaranteed and didn't lose money. Go and take a look at any other portfolio, regardless of who did it. Ray Dalio, Buffett, anyone. And you'll see that the losses they experience are not represented, not correlated in the stability of an asset like the whole life insurance policy. So that is, like I was saying, 150 billion. The last thing I would say about this is that this is also part of their portfolio that represents tier one capital. And if you've never heard that, if you don't know what that is, no problem. Basically, what that tier one capital expression is that is the most pristine capital that a bank can show the regulators to contrast that with the risky assets. In other words, tier one capital is what's used to compare to all the other portfolio of investment of a bank to measure their health and the stability. 25% of that tier capital one requirement is allowed by the law, by the Fed, by the regulators, for them to be using cash values of life insurance policies. So what I'm talking about is, and I bring this up for a particular reason, most people that hear that word life insurance will have skepticism immediately. And I think that's fantastic. But recognize that public policy is in favor and it's written for banks to use this. Yet the narrative in Wall Street and in the commentators of personal finance is that whole life insurance is a terrible place to put your money. Think about that. Who else knows about this? I'm not going to go into much detail, but Walt Disney took a loan from his cash values to be able to start the corporation and entity that we know today. General Electric, I worked for General Electric, one of the largest corporations in the world, was the largest for many years, was the pioneer of using this to give stability to some of their portfolio. Many other corporations are part of this, and their product instead of BOLI is called COLI, corporate-owned life insurance policies. Who else knows about this? Look at this, faces. In both sides of the aisle, Republican and Democrat, it doesn't matter. Our current president was reported when he was vice president to use cash value as a loan to pay for his expenses for the year that was not counted as income. Therefore, he didn't have to pay taxes. We're talking about the president of the United States. Why is this important? This is important because you have to recognize that we live in a world where we're constantly bombarded by these ideas, by commentators, by social media, by television, and they're trying to put a narrative in our mind. And sometimes those narratives are purposefully introduced because they serve someone else's benefit but ours. I am convinced that if people at the top of the food chain in our economy, and particularly the regulators that create these laws, the government, corporations, and banks are part of using this vehicle as one of their primary assets for protection and warehousing of their cash, we are being told that this is a poor asset for that reason on purpose. We're being manipulated. And I think the reason is that there is in their best interest to control our cash, to control our capital, to control our cash flow. Because like I showed you at the beginning, banks are using our deposits to create incredible amount of returns. So this is a phrase that we always talk about, and I think connects with closing with what I was talking about. The problem in America isn't so much what we don't know. The problem is what people think they know that just ain't so. It doesn't matter how you feel about what I'm saying. If you completely disagree with me, you think I'm crazy, you think I'm stupid, and I don't know what I'm talking about, good. I'm making you think. But just for a second, suspend that thought and ask yourself, do I for sure think that what I know is true? Or is there a possibility that perhaps some of the ideas that I've been introduced don't serve me as well as I think they do? So With all this in mind and all this context that I provided you, I think that stating the problem is really important. At the beginning of the call, I told you that I think most institutions and financial advisors are in the business of taking thinking away from you. They don't want you to think. They want you to follow and comply with their recommendations. I think we need to start thinking in America to know what's happening around us so we can do what we need to do based on our understanding. I think the problem happens to be with the fact that everything you buy, you finance. When you buy credit and you use someone else's capital and you're willing to use their money so you can purchase things today, you have to pay an interest on that. That idea is very, very, very intuitive. We all understand that credit is not good because it's going to be more expensive, blah, blah, blah. You have to pay interest on that loan. Understood that. The part that is less intuitive is the use of your own capital. So if you have gone through the capitalization process, you've had the discipline to save some money, and now you are going to make purchases. And I'm talking about anything. I'm talking about an ice cream cone to a rental property. It doesn't matter if it's a liability or an asset. If you're going to purchase that with your cash, the feeling you have, the idea you have is that, oh, no big deal. It's my money, so I'm just going to pay with it with cash so I don't have to pay interest. But the problem is that cash and capital is also another form of financing. Because if you did not use your cash to pay for that item you're purchasing, you could have rented that money. You could have lended that money to somebody and earn interest. Credit and cash are the same coin on opposite sides of it. Everything you purchase, you're financing. Get that in mind. Even if it's an investment, when you are making that purchase, you are either paying interest to somebody if you use leverage, or you're giving up the opportunity to earn interest. And that is, I think, the difference between the millionaires, the percentages I was telling you about, of people that have never inherited money, never made more than $100,000, but they've understood that equation, financing everything. And how can I make that financing work for me? When I told you about the premise for today, that whatever you're doing in life, it does not matter. It does not matter to me what you believe is a better investment or in speculation. Infinite banking can benefit you and enhance that because it will help you finance the purchase of those assets in a more efficient way. Separate those two things. Purchasing and financing are two things. When you buy a car, you buy a car, you buy a car. You're giving money up in exchange for that vehicle. But the way you finance it, whether you lease it, you pay with a car loan, you pay credit, you use you withdraw from a CD to buy that, you withdraw from an asset to that, or you use IBC. Those are all forms of finance, and one happens to be more efficient than others. So think about that. Today, when you go and purchase a new pair of pants that you love, or you're buying a rental property for your portfolio, or you're just going into your brokerage account and buying another $1,000 in one of your favorite equities, it does not matter what you're buying, you're financing that purchase either through credit or cash, unless you're using a system like the infinite banking concept process to make it more efficient. Okay. This next slide that I want to share with you is, again, maybe not representative of most of you. I know that a lot of you have sophistication in your financial life and probably understanding beyond the average American has in the United States. But if you were to generalize Americans, this is a very important visual, I guess, to understand what's happening from a financial perspective. Most Americans have 4 buckets of major expenses in their lives: auto or transportation, if you live in an urban area; housing, living expenses, the boat, the food, all the personal care stuff, and then savings. And the way this looks in America is most Americans spend around 20% in transportation, another 30% in housing, whether it's a mortgage or rent, living expenses, another 40%, and what's left, in this case, we're being generous, 10% savings, usually less than 5%. It defines the pattern of spending in America, okay? Most Americans do not recognize that beyond what they think about annual interest rates, APRs, annual percent rates, the most difficult thing to overcome is for them to take away the headwind of volume of interest. So From the research, Mr. Nelson Nash, which is the author of Becoming Your Own Banker and the person that identified this process of the infinite banking concept, created some research in the early 2000s to get average trends of how much volume of interest is represented in these buckets of expenses. So around 5% of autos go directly to interest that you're paying, whether you're financing or using cash, to other entities outside your family and yourself. Housing, a significant amount, the way mortgages are amortized, a lot of the payment up front is a payment of interest to the bank before you can create any equity in that house. It takes a long time to invert that equation. Living, if you finance boats, if you use credit card, all this volume of interest is heavy weight, heavy headwind that you have in front of you to progress. But in contrast, if you go to a party with someone and they want to talk about finance, they will focus on this little bucket here, 10, 5, whatever it is that you're putting away in a 401k, whatever it is that you're doing. And they're going to talk your ear off about how they selected the mutual fund and how they're maximizing their returns. And they're talking and talking and talking. But nobody's taking a step back and realizing that the headwind doesn't come from the acceleration of growth of their savings capability. It's coming from the 90% of their money that is taking all this interest and sending it out of their lives, out of their family to somebody else. What would be the outcome if you're able to find a process and methodology that takes all that volume of interest and turns it into part of your savings bucket? Ask yourself that. What would be, and again, I'm not saying this is a theoretical thing. I'm telling you that this is what I've experienced over the last 5 years in my life. I've taken the volume of interest that I was sending away and I've recaptured for my family to enjoy traveling, to enjoy living the life we like. And it's changed significantly the position financially from my life and my family. So with that in mind, let's just take an example. Unfortunately, we always talk about cars. And I think that the reason we always do this is because it's very universal, particularly in our society. We always can find in America a group of people, a region of the country that needs transportation. When we're 16, we always think about a normal expense that a child will need a car to move themselves to go to school. So cars are a very prominent example we use in IBC to talk about this idea of financing more efficiently. So when we talk about cars, again, keep in mind, you can use this for vacations, anything you want, but when you talk about a car, in a lifetime of an individual, the average for every American is around using 13 cars over their lifetime. Probably very correlated to my life. And I'm sure that some of you would say that that seems reasonable. Regardless, when you do this, you are financing that purchase the traditional way. Either you are using financing by taking a loan. You don't want to wait to use that car and save the money to use that car until you save the money. So you want to use the card today. You want instant gratification. So you're willing to take a negative balance and start making repayments of this loan until you pay it all and pay interest to the institution that lend you the money. Or you have the discipline to save the money. And when you have all the money, you go to the dealer or whatever you're purchasing the car and you draw that to zero, give the money away, and you have now the vehicle. Visually, regardless of the numbers of interest, what I want to make sure you capture here is that neither of these processes leads to any growth because they both lead to zero balances. You either are amortizing a loan you took and go back to zero, or you take all your savings and then go back to zero and start over and over again. There is no opportunity for compounding of your capital when you're exercising the wrong methodology. And unfortunately, in America, the only two methodologies for financing we consider are cash or credit. Now, the 13 vehicles will represent a spending pattern of around $400,000 that end in zero. When you use the banking process by controlling the entity that controls the capital and lends that money at an interest and keeps that money flowing, you are now jumping in a curve that allows the money to grow at the same time you have the opportunity to leverage that money. So you borrow that money to buy those cars, but if your money is uninterruptedly growing in a compounding curve, you are now starting to grow like the banks and the corporations grow their cash and their savings. This visual, again, to me was incredible when I first found this concept, because it helped me see why I was so frustrated. No matter how much more income I would earn every year, I would find a way to spend it. Unfortunately, I didn't have a healthy relationship with money, but also I wasn't using the right processes and the right platforms for it. When you do it like the banks do, you're still going to spend the $400,000. But now your balance is going to be much larger because you've been compounding that cash at the same time you create that repayment schedule. So we are leveraging the best of the cash strategies and the credit strategies by controlling the banking function. Same money, different results. Why you should be the banker. And this gets to the point of my premise, which is regardless, again, what you're doing today, you are probably a saver. You are probably a borrower in some instances. You probably have a mortgage, but very few people identify the opportunity to be a banker. And somebody else already is playing that role in your life, whether it's an institution, whether it's a family member, somebody's already benefiting from that. All I'm doing today is inviting you to consider that perhaps you could take advantage from being there as a banker yourself. Why now transitioning into life insurance? And to contextualize all that we've talked about, we think about the infinite banking concept as the triad of three pillars: a mindset, a process, and a product. We've talked about some of the ideas like you finance everything you buy. That's part of the mindset. You have to have the right ideas to engage with the process in the right way so you can actually be capable of being the person that does the process in the right platform. The process, as I've explained, is the banking process. Just like banks and corporations do, they put money to work. They create cash flow that moves and accelerates, creates velocity in money. The product happens to be life insurance policies. Again, very contentious point for many people. I think it's just either misunderstanding or, unfortunately, lack of clarity and a lot of noise in society. Why is it a good place to save money? Strictly and simply because it's the same entity from our perspective that the bank is, with the addition that it gives us a position of ownership. So differences between a bank and a mutually owned insurance carrier. Premiums are equivalent to deposits in a bank. When you deposit money in a bank, it's the same as paying premium and you create a deposit in an insurance company. When you borrow money from a commercial bank, you pay interest. The money that you deposit pays you interest. In the same way, a mutual insurance company pays you interest for used deposits. You have the ability to generate loans the same way that a properly structured mutually insurance carrier would provide an insurance policy with a loan provision. Profitability, we established that the banks are incredibly profitable. Life insurance companies have been around for more than 200 years. They've paid dividends for the last 150, at least the companies we use. So incredible record of profitability. And then the last part that I think it's misunderstood is that a bank will pay Jamie Dimon and all of the stakeholders, people that own the stock of the company, the profits of the bank, not you and I. That's why our deposits don't earn any interest or dividends when we have a checking or savings account, even a CD. But in an insurance company, because you're the owner of the contract and we are all mutually protecting each other, you get to participate in that excess profitability of the company in the form of dividends. So not only your policy cash values, the equity inside your contract is growing through a guaranteed interest, it's also growing through the profitability of the company in the form of dividend payments. Last thing I would say here to close this is, something that Einstein is attributed to: carry around the knowledge that everything you buy is not only costing you the face value of the product, but also what you could earn with that money for the rest of your life. And I put this here as a last question that I had for you guys is, a lot of times in what you're doing with your life, the question is, how much money do I earn and how much money do I get to keep? I think the infinite banking concept and the wealthy and banks and corporations advance that question a little further with a next step, which is, how many times do you get to use the money you keep? And that's the part that if you are not engaged in a process like the banking process, you probably won't be able to recognize, because once you use your cash and your capital that you've accumulated, it's gone forever. You've transmitted it to somebody else. I want to close this with a quick example of how this works, the solution that we're proposing for this financing of everything you buy through the use of a life insurance policy. Obviously, it's a simplified example. It is not representative of how we would exactly design a policy, and it isolates the effect of using an asset that you own and control, like the life insurance policy, to finance that example of the car purchases. So bear with me. If you have questions, we can go over them, and I'll try to point out the main things here. So when you look at an insurance policy contract, you'll usually see year by year breakdown of a few things: the deposits, any loans that are used in that policy, cash value growth, and death benefit. So I think this contract generalized for a 35-year-old male in good health, blah, blah, blah. Not so important, but the part that is important is that this person is going to deposit, they're going to capitalize their asset for 7 years with $10,000 a year. And as they do, their cash value, the current equity of the contract, is going to increase in a guarantee and in a non-guarantee schedule. But for this purpose of the conversation today, we're just going to talk about the growth of this cash value. The first thing that you want to identify as a rule for becoming your own banker is that you got to pay yourself. Whatever income you make, however it comes to you, you should identify that the first person to pay, the most important person to allocate capital to, is yourself. And that is demonstrated here in the way of deposits. The second thing that we're going to talk about is paying interest yourself. So what does that mean? Now that you've started to accumulate this cash and this cash value, you're going to start financing the expenses of your life. So we talked about buying 13 cars in a lifetime. If we start assuming that the first car you're going to purchase is a $15,000 car, once you have $18,000 of cash values, you can take a loan, purchase that vehicle, and start making payments to yourself or to your system for the $15,000 you borrow. You're going to do that as an interest. So when you pay annually loan repayments for $15,000, you'll notice here that $3,600 is more like $18,000 total. So it's $15,000 of the car plus another $3,000 in interest, just like you would pay a car company that is issuing you a loan, or any of the banks that would finance that for you. We're going to start sending those repayments. We're doing nothing different than what we would do normally. We're just using an entity we can control to repay this vehicle. The principle then leads to this realization. We, out of pocket, have put 7 years, $10,000, that's $70,000, plus in repayments of the car, another 18, that's a total of 88,000, minus the car that we purchased with that loan, 15,000. Out of pocket, we are $73,000. But once we repaid this loan, our cash values have gotten to $65,000. This, my friends, represents the fact that for every dollar you spend on that car, you got to keep 90 cents of every dollar. I would ask you to tell me if any of you in any of the cars you've purchased have today 90 cents back on every dollar that you spend on that vehicle. And I bet that it's very unlikely you do. Now, the most exciting part of this is not now, but because this is a compounding curve that is exponential, the growth over time gets more and more efficient, more and more exciting the more time passes. If you don't know, an exponential curve that is in a growing compounding positive rate of interest looks like a hockey stick. Over time, it's going to get steeper, 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 and it's going to grow incredibly the longer time passes. We repeat the process over and over and over again for the 13 vehicles. So the next time you do it, we were here at year 7 with $65,000. You can borrow 20. We're assuming that cars will go up in price, so you like a nicer car. Now you borrow 20 and you amortize that again for 5 years with the same interest rate. You're going to make these repayments. What happens? You took 20 out. You end up paying $4,800 every year. And at the end of the repayment loan, you have $81,000. So you borrow 20, end up paying 24. So the total out of pocket is really 4,000, but your cash values grew $16,000. Like in the banking example in the first slide I showed you, it's not the difference between two things. It's how much larger in proportion is their return for the out of pocket expense. $16,000 is 4 times larger than 4, which means that we get a 400% return in growth in our cash by financing the purchase of the next vehicle. I'm sure you can now see where I'm going with this. The next one, more expensive, more interest, more repayments. Now you spend 5,000 and you got 21, so your return is 430%, and so on and so on and so on. A compounding curve. You're borrowing, paying interest, but you are, for that use of the money, allowing the money to grow uninterruptedly, never access to. The last part of the slide here is how the process will look at the end. So now we're assuming that we've done the whole 13 vehicles. So the total accounting for this at the end is you put 7 years of $10,000 in deposits, and you created the loan repayment schedule times 12. So at the end, you end up paying $396,000 total dollars for all the cars, which is a total of 466. And we can obviously go through the math in more detail later. But you end up also borrowing all these car purchases, which is minus $330,000, which is a total out of pocket of 136. So out of your own pocket, what you've put in minus the loans you've taken is 136. Sorry, I couldn't see my screen. But your cash values are $794,000. On top of that, you are now also carrying protection in a death benefit over $900,000. This is a single policy. You only contributed for 7 years. I would never tell you to do that. This policy would never be designed like that for IBC, but this is a way to isolate why controlling the asset, controlling the entity that finances the purchases in your life is so powerful, regardless of rates of return, regardless of what else you're doing. Again, I don't care if you want to buy stocks or equities or bonds or cryptocurrencies or gold. It does not matter. I'm telling you that the purchases require a financing vehicle that you control, because you can recapture what other people is recapturing in your life today. This is just one last slide I wanted to share with you. Think about this. How many jobs is your money playing for you today? I tell you that today with my infinite banking system, because it's a portfolio, I don't only have one policy. I have a policy on my father. I have policies on my wife and myself. I have a 5-week-old that is in underwriting for policies, because this will be a way for us to keep money in the family so we can enjoy more prosperity. We can finance all the needs of the family, and it will be a vehicle for transferring that wealth generationally. Protected, private protection, because it's a private asset that is not seen in public record, protected from creditors, and transferable at the end of my life, tax-free. So all these things are benefits of this system. And I bring this as examples for you to consider if what you're doing today can be enhanced by including some of these things like increasing the capital in a tax-free manner, providing private lines of credit for yourself that you control, that you determine the repayment schedules to, the ability to earn interest, the ability to do the wealth transfer, providing capital for your family. If you're a business owner, think about this. How can you support better buy and sell agreements when you want to liquidate your business? Or if you need a succession plan, if you're ready to retire and you want to leave the business to the next generation without having to liquidate the business, but you want to cash out your portion of it. What about if you're a key person in a business that you need protection against because the business cannot run the same way or as profitable if you're not there, or some of your employees are not there? Living benefits, are you protected against some of these things like critical or terminal illness while you're using your assets today? Is any of your assets today protecting you against that? The ability to produce, again, passive income if you leverage the policy to acquire and finance some of these investments that are passive income. So I've given you a lot of ideas. I haven't seen any comments. Thank you, Amy. I agree. I think there's a lot of truth in this. Obviously, my perspective, but I think we share some of that. Again, my perspective today, I wanted to share this message with you because I personally think it's worthy of me. I think is that important in our society. I think is that valuable. Personally, I tell you that it's given me a significant amount of confidence in becoming a parent, in my financial future, in my prosperity, in my control of my finances. I can start to see it in my clients and the people I work around. And I hope that, again, as my stated purpose today, I've helped you consider a new idea that perhaps wasn't as intuitive to you, and give you a new perspective to consider if what you're doing can be enhanced or performed in a more efficient way, or if what you're doing is already working for you. Fantastic. I'm equally happy for you. And if in any way I can serve you, of course, I'm always here. If you are somebody that wants further education, more information, shoot me an email and I'll send you additional resources. I have endless amounts of information to share with you, as much as you want to learn. If you are somebody that is an action taker and you are very excited about what you saw today and you are ready to say, how does this work for me? Again, reach out to me, give me a call. We'll get on a Zoom call or on a phone call, and then we'll start talking details. I'm always happy to take you for lunch and discuss any further, but I want to know if you have what questions you have for me. Any comments, questions? Excellent. Thank you, Tara. Beyond thought-provoking. Thanks for challenging our thinking. My pleasure. Thank you for being here. Craig, how long before you can borrow against your life insurance policy? Well, you're the contract owner, and the premiums can be established in multiple ways: yearly, annually, quarterly, monthly. But usually once you pay a premium, within 3 days, the liquidity is available on the cash value. So normally when I pay my premiums, I just pay premiums in June. I borrow them a week after because I had a place where I wanted to deploy money. So the liquidity is immediately accessible. You are the first person. The loan provision states that you are the person in first position to take that loan before the company can invest any of those assets for the year. So it's very, very helpful, particularly for business owners that want to manage their liquidity. Is there a max per year? That's a lovely question, Craig. I return the question with this: how many bonds, stocks, cryptocurrencies, gold, any asset, any derivative, mortgage-backed securities, anything you want to purchase, how much would you be allowed to purchase in a single year? And the answer to that, Craig, is that there's no limit. Interestingly enough, the government set a limit based on some regulation for how much insurability you can purchase on yourself, because they understand the tax benefits and they understand all the benefits associated with this asset. And it's associated to events that happened in the 70s and 80s where they had to set a limit because the wealthy were transferring a lot of money from the real estate into life insurance policies, and they saw a significant amount of tax revenue. So there is a max associated to it, and it has to do with your maximal insurability, which is calculated by your economic life. A person in their 30s usually 30 times their income, and there's variation between your health and blah, blah, blah. But we can talk more details, but there is a limit to it. So even when people dismiss life insurance, they don't recognize that it's not just as simple as wanting it. You have to prove that you're insurable, or you have an insurable interest in somebody else. And it's a process to underwrite and get a certain amount of insurability up to a limit. It is a limit that is much greater than what you can probably put on the vehicles that are normally offered, like a 401k or 403b or some of those. Do you need a different entity business setup? No. As a matter of fact, we are very strong advocates of being owners individually of our policies for ourselves before we engage with an entity like a business. This is something that is private, is not shown to the IRS, it's not shown to any creditors. So nobody knows. When I report my taxes, nobody knows how many policies in my portfolio are allocated, how much cash value is there. Even when I take a loan from them, it's never reported anywhere because it's not income, it's debt. So you don't need that business entity to set this up. It's actually an individual. We advocate for individuals to own at least the major part of their insurance, because this is an asset that you want to have total control of, and it's transferable. You can transfer it to anybody, any entity in the future if you desire, but we start with the individual. How do you get into Bali, or is there something else different or a different term for an individual? Bali is just a product that is offered to the institutions like banks. Collie and iCollie are other products that are issued for trusts, corporations, and so forth. For individuals, we're talking about high dividend whole life paying insurance. We happen to work with mutual companies, very few of them out of all the companies in the country that are able to provide us with the circumstances that are optimal for the banking process. For example, the ability to access loans, the ability to pay excess premiums so we capitalize the policy faster, the flexibility in the design. So if you want to talk more specifics about that, I'd be happy to in a separate call. Liquidation complications. I'll say the last thing is interesting because, again, another thing that is very misunderstood about insurance, whole life insurance contracts, is that they are a unilateral contract. What does that mean? A unilateral contract is when two parties engage in a contract, but only one party has the obligation in the contract. So In a whole life insurance policy, the contract says that as long as the insured, us, continue to make premium payments, the insurance company is obligated to respond either for the death benefit and the coverage of protection when we pass away, and it's not if, but when, keep in mind, or if the individual does not want to engage in the contract anymore, the ability to surrender the current cash value, which is the current equity in that contract. So you decide, do you want to leave it? I wouldn't suggest it. If you want to leave it, I'd tell you, call me, because I'll purchase the contract from you so you can transfer it to me. That's how committed I am in understanding how profitable this vehicle is as an asset. But it's your decision how you manage that and if you want to terminate it. There'll be so much flexibility in using loans to pay premiums and reducing your premium from a certain perspective. So you never have to let go of it, because I'm telling you, it's the most important asset you are going to add to your portfolio, and it's going to enhance anything you're doing today. So thank you, Craig, for those questions. Very thoughtful and super helpful to add some context to the conversation. Amy, thank you for your kind words. Really appreciate it. Any other comments, questions? If you want to, oh, Joey, go ahead. Sorry, man. Let me see if I can unmute you. Are you muted, Joey?
Yeah, can you hear me?
Yes, sir. Thank you so much for being here. Do you have a question?
Yeah, happy to join. Great presentation. Just wanted to mention I'm 2 years into a policy, and just something from like the kind of the emotional part of switching over from having a 401k into starting a policy, and the ownership that I gained and the feeling of like actually controlling my money was something I wasn't expecting, but a great benefit that was a great surprise also. And just allowing me and my wife to really control where we wanted to spend our money and how we wanted to finance ourselves and our lives. And the 401k money was always so theoretical in a sense, because it was not until 59 years old when I could actually access that. But this money and having a policy has allowed me to pay off a car, use it to put a down payment on a home, and I still have the policy and I still have the ability to finance my life through that. And so it's just been from the financial part, it's been also like the emotional, psychological part has been a surprising benefit that I just wanted to share.
Thank you for that, Joey. I really appreciate you sharing your experience. And I know you're a humble person. I don't mean to brag about you, but you're being kind and conservative with your comment. You were able to finance a portion of your master or your advanced degree in Harvard. You got married. You started a new business. A lot of prosperity has come to your life, and I'm not saying it's only this. It's you. You are growing. You're becoming the person capable of bringing all this prosperity to your life. So it's all about what you're doing and who you are becoming. But I'm convinced that a lot of confidence to take these steps have come from the solid foundation you're putting your family and yourself with your financial life. So thank you for sharing that. It's been an honor to serve you, and I look forward to all the growth you and I will experience, and hopefully we share with more people.
Definitely. Thank you, buddy. Appreciate it.
Absolutely, man. Anybody else? Any other, my friends? Emmy, I always love hearing from you. Hi, Emmy.
Thank you. Hi. So David, I do want to share with everyone just in, our own experience, right? My husband's an orthodontist, and even if I just want to really share the difference it made in our lives for the last few years. Like, my husband makes good money, and yet at the same time, we knew we are better than anybody else. At the same time, he was always thinking about emergency funds. So I don't know if any one of us here is really always thinking about emergency fund. There are ways where they say you got to, save this much, 6 months and all that. So even though we made money, he was always worried about emergency funds. So we had to always budget. And since we did infinite banking, like your friend shared, right? The unexpected benefit of it was actually so much peace of mind. Like, we poured our money into the infinite banking. He researched for it for 3 years, by the way. So we put everything there, and guess what? Since we started doing that, the benefit of it was really just pure peace of mind, because we don't have to worry about emergency fund anymore. And, and all that opened up whole new energy and space for us to really see opportunities. Because think about it, the amount of worry we put into, worrying about something, if we eliminate that, a whole new world emerges. And so what happened there, coming back to today, is that through infinite banking and what we did with it, like my husband actually maxed out what he could into buying the premium and the policy. And people think that, yeah, well, you have the money. And actually, no. There were times when he didn't know, like, how can he finance his policy? But then again, this is really where you all come in, right? Like, you are very strategic. You're the best consultants. Trust me, you're amazing. I can tell, David, that you are a great person, right?
Windows and patio.
And so when we did that, it's like the whole world now has changed. We have increased our wealth. Yeah. Yeah. We had increased our wealth, unexpectedly faster than we thought. And now we have real estate, our buildings, our practice buildings are all financed because of infinite banking.
Mhm.
And because of the money that we had access to, we actually borrowed money from our bank, infinite banking money, and then put it into our business. And in that first year, we grew our practice by up to 100%. And that is
Amazing.
huge, right?
Amazing.
So this is really telling you about the power of cash flow and the power of using money, and especially because it's not locked up. Like, imagine making your money make more money. It doesn't have to be even other people's money, but the money that you have access to because you believe in the system and the system actually works.
Yeah.
So I just want to put that in because, at this time, we do worry about money. A lot of people do, right? So thank you, David. Great service today. Great education. Appreciate
Thank you so much, Amy. You're so
You're
kind,
welcome.
sharing your experience and your comments, and thank you for the kind words. What you said made me think of something, and some of you may know this because you know me personally, that I always try to share something from my personal life. I actually came at this not from I want to be aggressive, I want to grow financially. I came at it from a risk aversion perspective. My mom passed away when she was 44. She was very young. Me and my brother were very young. My brother was only 9 years old. My brother was here in the call, actually. And my dad had to go to work on Monday because our life in our financial situation required having more income. And we didn't have the opportunity to mourn my mom. Life insurance has always made sense to me. But what I did not know the first time I acquired it back in 2011 when I started working is that I had a greater need for financing that for protection. And when I understood the product to the level I do now, I could see that both of them make this asset one of the most valuable assets in the entire world. And it's only available in places like the United States. We're so lucky to have access to it, but yet as middle class, we don't think through it like that way. And the way that I can tell you it's benefited me the most has nothing to do with financial indicators. It's not about the rate of return. It's not about how my profitability has improved. It's not the fact that I paid entire debt. I maximize my insurability, my wife's insurability. I just apply, and I'm not in the writing form, the maximum they would insure my son, because I'm in the mindset now that I don't know what's going to happen in the future. I'm 35 years old. I want to start now that I'm healthy, that I'm able to do it, that I'm in a good position financially. And it's giving me also the faith and encourage me to know that financially I'm going to continue to grow, because the more I grow individually, the more I'll be able to serve other people. And that is going to translate into continuing to increase that portfolio. So that is my personal experience. Again, my opinion, my perspective. Amy, Joey seem to share it, of course, but you could have a different perspective. And I love to hear from you. I love to hear what you're doing. I love to hear, again, where you are, where you would want to go. And if the bridge you're building gets you there, or if you think that what I've talked about today could enhance the ability to get there or get there faster, reach out to me. I'd love to hear from you and have a call, have a conversation. I'm here to serve you. So thank you all again for your time. I don't want to take over any more of your afternoon. I really appreciate your attendance, and I hope to hear from you soon. Have a great afternoon, everyone.
Thank you. Do more, David. Bye-bye.
Bye.
Thank you.